All right, today we're digging into Benjamin Graham's core philosophy. You know, the mentor who pretty much taught Warren Buffett everything. We're looking at his classic, The Intelligent Investor. And the really radical idea here is something quite counterintuitive. What if the actual secret to getting rich isn't some magic stock pick, but just learning how to protect your wealth, how to,
Yeah.
not lose money?
Exactly. That really captures the essence of Graham's value investing. It's the art, really, of buying a piece of a business, a real asset, for quite a bit less than it's actually worth. Intrinsic value, he called it. And this takes discipline, rationality, emotional control. It's not about trying to predict the future, like the next market crash or interest rate move.
So it's about the business itself, fundamentally.
Right. Graham believed the stock market, well, it's definitely not a psychic hotline. It can be like a voting machine day to day, driven by emotion, by hype. But crucially, in the long run, he saw it as a weighing machine. It eventually recognizes and rewards the true underlying value of a solid business. Success comes from trusting the facts, the business fundamentals, not the noise of the crowd.
Okay, that focus on fundamentals is key then, because it helps us make a really clear distinction, one that honestly most people probably blur, the difference between investing and speculating. Investing, for Graham, means you're actually owning part of a real business and you trust its long-term performance. Speculating, that's just betting on short-term price swings. Chasing a quick buck, basically.
And, well, this leads us straight into probably the most critical behavior lesson in the whole book. Meet Mr. Market. Graham paints this picture, asking you to imagine you have this business partner, Mr. Market, and he is completely unpredictable, utterly emotional.
Right, the manic depressive partner.
Exactly. He shows up every single day. Sometimes he's euphoric, offering to buy your share of the business for a crazy high price. Other days, he's utterly despondent, willing to sell you his share for way, way less than it's worth. His prices are all over the place, totally disconnected from the actual business reality sometimes.
So the intelligent investor's job is what? Just ignore him. Treat him like background noise, because that sounds hard if he's offering a bargain.
Well, yes and no. You ignore his moods, his panic, his euphoria. You absolutely treat his offers as optional. He's there to serve you, not guide you. But you don't ignore a genuine opportunity if his emotional pricing creates one.
Ah, okay. So if he shows up offering something great for 50 cents on the dollar,
Then you potentially act. But only because your analysis, your rational assessment, tells you it's a bargain. You don't act because he's panicked. And that's where Graham's absolute golden rule comes in, the margin of safety. Because, let's be honest, figuring out that intrinsic value isn't perfectly precise, right? There's always some uncertainty. So the margin of safety means you only buy when the price is significantly below your calculated value.
it's like a buffer zone, a safety net against being wrong.
Precisely. It's your financial seatbelt. Graham wasn't just talking loose common sense here. It was a strict principle. Historically, he often looked for quite substantial discounts, maybe buying only when the price was, say, 25% to even 50% below what he figured the business was truly worth.
That cushion protects you. Even if your valuation is a bit optimistic or things go slightly wrong, that deep discount helps prevent disaster.
And this connects back to how you, the listener, might apply this. Graham knew not everyone wants to or can spend their life analyzing stocks. He actually outlined two paths. There's the defensive investor.
The one focused on safety, minimal effort.
Yes, prioritizing ease and avoiding big mistakes. Maybe a simple, structured portfolio, like a strict 50-50 split between diverse stocks and safe bonds. Low effort, steady.
And the other path?
That's the enterprising investor.
Yeah.
This is the active one. This investor is willing to put in the serious work, the deep research, the analysis needed to find those genuinely mispriced opportunities where you can apply that margin of safety aggressively.
But the key is, if you don't do that homework, you absolutely must stick to the defensive approach. You can't just dabble.
No, absolutely not. And that diligence brings us back to the psychology. Real wealth, Graham insisted, doesn't grow from trying to time the market or reacting to every scary headline. It grows through patience, through discipline. You compared it to planting a tree. You plant it, you nurture it, but you have to give it time to grow and compound. Years, not days or weeks.
Constantly digging it up to check the roots, that's like overtrading, right?
Yeah.
Driven by fear or impatience.
Exactly. That kind of behavior, checking constantly, reacting emotionally, it pretty much guarantees poor results. In the long run, facts about the business, they always win out over fear and hype.
So when you really absorb this material, it seems like it changes more than just your investment strategy. It changes how you think, how you handle pressure, how you maintain emotional control.
It absolutely does. It promotes rationality, clarity, especially when markets get chaotic.
Which leads us to a final thought for you to consider, straight from Graham himself. If intelligence in investing isn't really about high IQ, but about discipline and controlling your emotions, then maybe remember his warning. The investor's chief problem, and even his worst enemy, is likely to be himself. Makes you think, doesn't it?